If we are at 333, I don't think that will be the point of the single gold silver ratio single. I think it's more likely we'll be in around the 30s at that time. So this is a little bit of Chinese mathematics, if you'll allow. But if we're in and around the 30 level, I would imagine that you'll be around 10,000 when we hit 333. And I would imagine we'd go well beyond that in due course by the time we go single digits. So I do see 4-digit silver and maybe even possibilities of 5, but that will also be again about the dollar as much as everything else. The net effect of those kind of talking is that you could be at 50s, 60,000s in gold by the time that occurs, and maybe more.
Hello everyone, welcome back to my channel. Today I'm joined by francishunt, a well-known market analyst who is respected for his disciplined and focused approach to the market. He's a trusted voice for traders and investors navigating uncertain conditions. Francis, it's a pleasure to have you here.
Thanks for having me on. I'm delighted to be with you.
Right now, gold is about $4,500 and silver at around $75. Let's start with the price targets. You have mentioned silver will hit at $333. With today's uncertainty and consolidation, what would need to happen for that to be realistic?
So for the targets to be met, we think on balance of probabilities, everything is exactly where they should be. So there's no revision to our expectations at all. Some people might say, but you were at $121 and now you're in mid 70s at the moment. What about all that? So our targets are not thumb sucks. They are geometrically determined from technical price behavior. And as part of that methodology, if you'll allow me to share screen, I can even give you some color to that. If we go to, that was the Indian rupee, by the way. I was highlighting on a previous interview the loss of value in the currency. Let's get silver up and let's discuss the target. So you've asked particularly about the silver target of 333, I've understood. So first of all, where did the 333 come from? It's probably worth giving some color and some detail. It's a multi-decade technical pattern that has been setting up. So it's a very long time frame pattern. And the interesting thing about long time patterns, Umar, is that first of all, most people don't have the patience to wait them out, and they think everything's going to go up overnight in straight lines. This is typical of impatience, the get-rich-quick tendency we all have. We would all like things to be much faster necessarily than they would be. But in actual fact, you're going to make fast progress when you look at it on the big time frames. But that doesn't always mean it's going to be fast enough for the average man in the street. Especially if they weren't aggressively in this particular trade early. So I've put on with the use of our HVF method, which is unique to us, our technical strategy, the draw. So just to give you a bit of color, because this is the first time I'm appearing on your channel. Where does the 333 come from? So in essence, you've got a multi-decade event that saw the fixed pricing era that came out of the original establishment of the Federal Reserve. You had this big bull market of 1980 that peaked in and around the 50 mark. This chart's data is not perfect. It should be a slight bit higher. So I have to put an imperfection here, but that's a technical detail of the data, not the setup itself. What you've actually got is a multi-decade squeezing pattern, which means we had very tight volatility at one point that suddenly broke out. And the breakout occurred for us, first of all, on our earliest squeeze here around $25, and it was confirmed at the $30 mark once we were taking out this third localized highs. So we have 3 highs, there's 3 impulses to this, each one getting smaller, higher lows, but lower highs. That's the compression part. We then got something very unique, which is a squeeze within a squeeze. On a lower time frame, you've got another 3. We call that a primer. And that set up the earlier break entry and the stop loss trade. So this trade, when taken on a quarterly, note the 3 months, Umar, will take you to $330. There's a slight adjustment higher in actual fact, which is why we've gone with all the 3s for everyone to remember it, because of that not quite showing 50 when it did in fact trade through 50 on the Hunt Brothers event. So we warned that when you make this particular target, which is in the late 90s, and as I say, this should be a little bit higher because of that, because it comes out of the geometry of the charts, these targets, that you would probably face some pushback for a while. And that's what happened when you ran that 90.5 into the low hundreds amount. In fact, you topped out at 121. Big shooting star, big rejection once you'd gone that far. Of course, they pushed oil up now during this period, and that has actually seen oil go up, and that's been a little bit of a drag on the metals, because when oil goes up, inflation expectations go up. We've described oil as a something that masquerades as a commodity in military uniform, but is actually a financial weapon of mass destruction because it pushes inflation so strong. Yeah, inflation pushes the bond yields up. That means bonds pay a higher yield, and gold does and silver doesn't. So that can short term put pressure on the metals. That literally had to happen, Hormuz, because this was getting runaway hot. Anyway, you pause at the secondary interim, but when you re-engage and finally break, you will go quickly in the open areas before running the target. Then you will pause again. So that is typical HVF method performance. So you have a strong run. There you can see we've had that. Then you have congestion, consolidation, and then you have another strong run to 333. As I highlight, this will also be very much about the devaluation of dollar and fiat generally. You saw the Indian rupee as well as we pass by getting to the silver chart. On a lower time frame, if I give you the weekly, technically, just so that everybody understands, on a lower time frame, we also can do technical analysis. We have a falling wedge structure, and we typically expect waves of 3 in selling. It's not exactly in the middle. We call this the splitter, and it divides that. There's your first major wave of selling. There's your second. And we've had this rejection, a fake attempt to break out that's currently being rejected. So there is possibility for further downside on silver for a bit. It might bounce on the splitter. It could even visit all the way down here. That could be on sell in May and go away. We've got a new Fed who wants to be very dovish, who wants lower rates, wash, which is going to be very inflationary. That's going to see bond yields continue to go up. That's going to keep a bit of pressure on gold and silver when the yields are going up. You could sell off here. But in the longer term, if you're patient, the break here will, in our opinion, come in due course, even after a sell-off, and then we'll be beginning our journey back up. So that's a little bit of a synopsis of silver. No change to our expectations. This was an expected pause period. It feels like a long time because it was January, end of January at the highs. Remember, this is a 3-monthly multi-decade, right the way back to the highs of 1982 and even the bull market before that into 82 pattern. So it's a generation, I don't know when you were born, but this spans my lifespan, from 68 to 82 and all the way through what's happening. So people need to be patient.
Okay. As we see in the previous bull markets, silver hit $50 and pulled back strongly, and even a recent one, silver hit above 100 and pulled back even strongly. So what do you think, if silver will hit at $333, then how much it will pull back?
I would expect it to have quite a strong, it's fairly volatile metal. Don't forget, making 333, it's likely to be in a very powerful upside move. So when you have that momentum to the upside, that's absolutely smashing you forward and upside, you're in a blow-off moment. We had a little bit of that here. We were sitting at 49.5. The 50 pullback that we said would happen wasn't that deep. You only went as low as around, let me just check that number, because 50 was a very relevant number you mentioned. I think the low was, what was it, 45? So you went to about 55. The high was 54.48. You went almost to 55, pulled back to 45, little nod of the head, a little tip of the hat to the 50 level. And then next thing you knew, you're at 121. So that was a blow-off move. So we were moving incredibly quickly during this period. And that's typical. You should expect a blow-off and a pullback on that. And your question was around the 333. I would expect a similar finishing event. So whilst 333 was the target, you'll probably smash through that. And you might who knows, 350, 360, 375, who knows how much more. But then you could have another 40%. You might even have a 50% correction. You could come back to 180, 190 as part of a consolidation. So it's going to be a very volatile period. And we'll take some profits at a trading level and maybe sell a small amount of investment. But I do caution that our longer run expectation is that you will have a single digit gold silver ratio. So that means we must trade below 10. So 9.99 qualifies, call it 10 if you want, but you might even go beyond that to come. So that will be another measure. And we have other methodologies for giving silver-based values beyond the 333. So it's not our top call, but it is our HVF method, which is our most reliable targeting method, dollar-based call.
Okay, as you discussed, new about the Fed, new Fed chair coming in. There is a lot of news, as you discussed in this interview as well. So there is a lot of news about the new Fed coming in and war uncertainty, global uncertainty, war risk, inflation, debt rising. These all are factors which is hugely impact gold and silver prices. Why gold and silver prices are still consolidating in a specific range?
Yes, so your question is, given the new Fed chair, why are we not yet seeing movement? You might well be seeing movement associated with that. So just to talk about the Fed chair new, it's quite common that corrections in stock markets and in other markets do take place at the handover point because it absolves both parties of guilt. Technically, the new guy said, well, I've only just come here, it's all baked in because of the predecessor. And the predecessor says, well, I'm leaving the office at the moment, and this is someone for someone else's situation. So quite new in a new Fed chair. It's a great way to clean out all the cobwebs and have some volatility, have some sell-offs, have a bit of a mini reset, or potentially a big one. In terms of Walsh himself, he's put forward that the inflation measure is incorrect, and he's found an even more understating inflation measure. So I refer everybody to the fact that central bankers are pursuing a policy always of inflation, and it's rarely enough inflation for them. Why? Because this gives them huge advantage. They have you in monkey money that is debasing and going down. They drag you into higher tax bands when you get increases that are actually really just value-based maintained price points. Remember, if you're getting a salary in monkey money, it is diminishing on you at the rate of inflation all the time. So that leads to bracket creep in taxation. So they get more of your income. Inherently, inflation benefits the billionaire and banker, particularly the central banker classes, at the cost and expense of the general citizenry. That's the middle classes right down to the working poor and everyone in between. And that is their policy. So, the Gini curve, which is how much wealth is held by what percentage of people, inevitably they want the bulk of all things to be owned by the ultra rich, which is why the World Economic Forum has "you will own nothing and be happy" as a strapline. So in terms of all of that, the new Fed chair is already removing the basis of comparison by changing the measuring tool. It's a bit like I adjust the ruler that I am measuring your success by, and I have a new ruler which is more stretched than the previous one. And I say, well, you're not as tall as you say you are. You're actually quite a bit shorter, and I've stretched the tape. This is in essence to it. He's removing the basis of comparison, and he's going to make it quite a bit lower, and that's going to justify a far more dovish approach to monetary policy. And if you're more dovish to monetary policy by approach, what you are effectively doing means you're going to allow the debt market to devalue even more so than it is doing at its current rate. So debt and fiat debasement is the order of the day. Think that rupee chart I was just showing you. Well, there's many different currencies. Even the dollar in its own terms is doing that. And your costs of living, we're going to face a steady increase in cost of living, very stagflationary into almost what we've described as hyperstagflationary. So your income may go up, but it's lagging the true cost of living. Less disposable income, more assets have to be sold to fund your lifestyle. This kind of environment, labor and work and pay rates well below the real true inflation, and they are liars seeking to misrepresent that inflation, the central banking cartels. Let me hand back to you on your question.
Okay. Moving toward before moving towards gold and silver ratio, we just let me know about what is your target about gold prices?
That's a good question. We don't have the same upside HVF for gold prices as we do for silver. But if we are at 333, I don't think that will be the point of the single gold silver ratio single. I think it's more likely we'll be in around the 30s at that time. So this is a little bit of Chinese mathematics, if you'll allow. But if we're in and around the 30 level, I would imagine that you'll be around 10,000 when we hit 333. And I would imagine we'd go well beyond that in due course by the time we go single digits. So I do see 4 digits silver and maybe even possibilities of 5. But that will also be, again, about the dollar as much as everything else. The net effect of those kind of talking is that you could be at 50s, 60,000s in gold by the time that occurs, and maybe more. We don't have something particularly hard and fast. I'll be doing point and figure targeting, which is a different methodology, which is still strong, but not as strong as HVF method targeting. And I'll be sharing those on X later on where I think gold will probably be post a major reset. You've got to remember the dollar may only exist in CBDC form, like a stable coin at that point, and there'll be no more physical cash. It'll have had a timeline. They will have called all the notes in, or they would have been destroyed as worthless. This could follow some banking crash and a lot of other major events of shock and awe to distract us all from this entire rotation out of the old system into some form of CBDC-based surveillance grid, biometric, emphasized type financial prison pen, I would describe. So yeah, would you like to see the chart on gold? And let me show you how I frame it right now. If you would like to see shorter term, how we are seeing the gold, I'll just pull it up and we'll give you the technical take shorter term on that. If I just put on some of our technical draws on here, this is the weekly. So we use quite big time frames. I'm not on the absolute biggest. Again, I was mentioning to you, we always expect 3 waves of selling. Markets typically do this. The first wave would have occurred there when you were almost at 5.6 and you sold off to 4,400. Let's make that structure a little bit bigger because that's kind of a little bit small. It's focused on the consolidation, not the up move. It's easier to see 3 waves of selling. You're quite clearly shooting star here. This is known as a rejection candle and a potential period of pullback. There's the shooting star. And of course, you went all the way down to the 4.4. So that was $1,200. Then you had a rally, and then you had another harsh sell-off to about 4,098. We then had a grinding rally. We've come up against the channel top here, which we call a capping descending grind line. And this is a basing descending grind line. Together, they make the channel of continuation winding up. So this overall, we suspect, is a continuation pattern, but you take some time to come out of it. I think there's a third sell-off to come. I don't think it'd be as violent as this one or this one in terms of scale and also the momentum, how steep it was down. But you could find that you could drift off, particularly if there's a AI crash or there's an oil price spike, which could force yields up. And of course, the debt markets are very badly set. So initially, the yields going up puts pressure on gold and silver. In the longer term, eventually, everyone rotates out of bonds into gold and silver on the basis of fiat and debt debasement. It doesn't matter what yield you're getting. If you're losing all your capital, it's much better to be in gold, even though it doesn't pay a yield. So we've got to go through that cycle, first down, then up. And that's the possibility. So where do you bottom out? Is it 4,100? Is it somewhere here? Could it be a new low to the previous low? Or could you bounce on the midpoint? Sometimes that happens and you come back up. You only have a partial sell-off, because the whole idea is the volatility is weakening. And if everyone who wanted a panic sell, you got the shock there. You got the disbelief that led the second rally. Then you got a harsh second selling that says, nope, this is for real. And then you've got a weaker rally, and then you've got a drift. This should be the weakest point momentum-wise of selling. It should take longer to go less far down. And so where's the low? I don't know, but I'll be buying the turn when we break this capping descending grind line in terms of continuation to the upside. And that's going to be a technical trigger for us. So first down, then strongly up, potentially.
Is there a possibility to hit $3,500?
In terms of the low side, anything is possible. We can't rule it out. And as I've mentioned, it would need a bigger degree of crisis. If we get a liquidity squeeze that a demand-destroying event would bring, so we suspect, particularly Korea and obviously the NASDAQ, the Kospi in South Korea, the speculation in terms of SK Hynix, we've done a full Substack post on this and many YouTubes on the USD Korean won, the downside, the overcommittance of the Kospi's run. It's done about 254% in the last year and a bit. And the NASDAQ has done a lot as well. These are very, very expensive stock markets. If we get bond yields going up because oil price gets a secondary surge, let's say the Iran Hormuz thing re-warms a little bit in terms of hot conflict, you could have a very, very uncomfortable bond market debasement. The bond market has to go down in value. That means yields long-term have to go up. How they engineer it, will it be another wave of Hormuz? Will it be something else? I can't guess the narrative that will go with it, but devaluation of debt has to occur. There's too much of it. And it's grossly overpriced. And there is less and less buyers. China is no longer actively adding, is aggressively adding gold and silver. Couple of key things on that point, by the way. Don't take my word for it. Just have a look at this. China's been buying and is trading silver at $83. And in the West, it's sitting at 75, 66. You're talking about almost an $8 premium. And this has been the case for 7 months. This is how one part of the world says, we'll pay more, come to us. There is a bit of arbitrage and obviously travel to spoiling. There's a bit of frictions to being able to arbitrage that perfectly. But it means the West is letting go of precious metals and the East is aggressive buyer to it. And that very specifically China in that. And if I show you some other things, the UK imported from America 600 tons of silver in March and exported most of it to China and India for that matter. So China is draining the COMEX and the LBMA. So you are seeing strong moves of metals moving east, and the West is getting hollowed out. So the West is not going to do well in terms of its position holding sound money. And here's more people confirming the UK imports and ends up moving it all on to China. So it's literally an LBMA clearing exercise. And the other aspect is with energy, Peru shut down a large amount of mining because of this energy crisis. That obviously readjusts the amount of silver coming into supply, and the price will eventually go up if supply chain is reduced in volume. So it's a matter of time. If you're investing monthly, it's one of the safest things to do, dollar cost averaging. That's great. Our community focuses on the trading opportunities. So we build wealth in an accelerated format with tight stops on the volatility squeeze moments. And we see silver as one of the core markets we will be continually trading for those up moves. The next major move to 333, which we will be aiming to try grab a good entry on. We will hold strongly all the way till then, and it will be incredibly beneficial to all those involved. And that's what our community focuses on: building wealth, protecting that wealth once you have it, and you have to spend a little to do that, and developing a multi-jurisdictional footprint as well. Because as you've seen, if you're an Indian, for example, you've seen what Modi was saying, don't buy gold. He doesn't want you to buy gold because the rupee is devaluing. That means you're rejecting the rupee, selling the rupee, and buying sound money. So you should invert most of what these politicians say if you're interested in doing the best by yourself and for your family in terms of wealth building. So let me hand back to you.
Why Modi did not say don't buy silver, just don't buy gold?
So my primary expectation is that that's probably inferred as well. However, he needs to bring in silver for industrial use. So silver has a dual role, potentially, and industrially, he's probably aware that he needs that. Whilst gold is largely ceremonial and money storage. So it's the one that's more primarily the money and the store value substitute to the currency. And the greatest problem he has is foreign exchange reserves. So India relies on imported energy and also imported metals. But the one has an industrial use as well as a monetary hold and is lower value, whilst the other is much more higher cost. So it's many more rupees that get thrown back into the market to be sold to acquire that asset. So the greatest damage is actually on gold buying to the currency because of the high value of gold. And also, there's, apart from jewelry, industry-wise, it doesn't have a use case where India is making a product and then selling it on. Silver may well be an input in certain manufacturing that might be occurring in India and therefore is required.
Okay. So, as we discussed, gold and silver prices rise a lot, especially for silvers. If that happens, how do you think inflation and general prices would also move up and creates any broader risk for the economy, as silver has dual role as monetary and industrial?
There will be immense effects. We're in economic case history times. This will be larger than the stagnation of the 70s, which was known as stagflation, that followed the Vietnam War cheating by America, where they printed more dollars than they had gold and silver. And then their allies called them on it and started asking for the metals instead of the paper and handing back the paper, which is a little bit of what Modi is trying to prevent as well. Every major fiat gets caught out when people want to hand the paper back and demand the metal. And that led to the not so temporary closing of the gold window that is still closed to this day. And that is where we went free float system, where it's relative valuation of a fiat to another fiat on a free float basis, providing everybody equally all commits the same sin. The relative valuations of the fiat don't show the cheat code that is being applied of inflationary policies by central bankers, because everybody is issuing more currency than they have backing for it, and just the degree varies. That's kind of a little bit of the answer. I hope that helps explain. Let me know if you need more detail.
Yes, let's move towards gold and silver ratio. As we discussed, many people expect gold and silver backing towards single digits, 10 to 1, 9 to 1, or even 7 to 1. What do you think about gold and silver ratios?
Yeah, so the gold silver ratio technical analysis, let's go and grab the charts again, because that's best explained visually as well. So here we go. Let's bring it up. So this is the gold silver ratio chart. And you can see the history in the chart. By the way, the candles are different thickness because of volume. So you can see the greater significance that has come in more recently. Let me just hide my scribbling so that everyone can first recognize the chart. You can see how much more volatile it's been here and how much fatter the candles have got than compared to the period over here, for example. These are fairly thin and those are far more substantial. So that highlights the volume, first of all. That points to much more engagement by the market generally. If we go to how I've carved it up, we had a 65 level that was a very key level. And I'll just sketch it very simply. I don't want to teach too much technical analysis in a short question, but essentially we call that a head. My apologies, a left shoulder. That's a head, and this sort of kind of very bulky right shoulder. So it's not a perfect, but it's got some aspect to it. You can see there's an interaction there. There's an interaction there, and that was a triggering event to the downside that you've subsequently ran the 50 over here on the gold silver ratio. It's quite some mark. It hadn't been above or below the 50 since 2011. We're 15 years from 2011. That's quite some time ago. Might not feel like it, but when we ran the 50 here, that was quite a big deal. And in fact, the low of it was 43, which is really substantial. You're right back to this period over here. So this little bit disproportionate head and shoulders, I'm not going to tell you it's a classic, has a downside target in and around the 30s here, 32. You'll see it over there. So we think you're going to be in a winding up structure here. You might, even if precious metals sell off, first go up in the gold silver ratio. Those that understand that will know it's not to be desired. It means gold and silver are going down, silver more so. You might go up and you might even make an 82. It's not impossible before, I suspect, some degree of sell-off again, and we'll end up back coming down. At the 32 level, I would imagine we could well have run that 330 if we experience this down leg. But we first might be looking at an upside. So let's leave the monthly and just have a look at a lower time period why we say that. You might be. Generally, we hold this opinion softly. It's not a highly aggressive, assertive opinion, but there's a degree of bull flag here for possible move above the 65. This neckline was a very key event, and we've drawn it a few times. So there's a tendency to the price attracts back there. So you can see you broke it with real momentum. You overperformed to 43. You smashed the 50. Now you got that snapback rally. You went all the way to 72, but it got sold back. And then you formed this continuation pattern, which is known as a bull flag, that may suggest that you have an upside to around 82 there. Again, I'll show it to you without all the drawings. It's easier to draw, and I'll drop the time frame so it pops a little bit easier for everyone to see. But that's how it would look potentially. So there could first be an upside. That said, if it doesn't trigger and beat the 65 and it comes back down, how do we be wrong on that? You go there and you end up spilling really hard and you make a new low. That can just out of the blue happen. But when you get this kind of pattern structure, there's a higher possibility that this is continuation to upside. As I've mentioned, not a favorable move if you want gold and silver to go up. But this could be on the AI crash, bond markets crashing, yields climbing. It would be a very uncomfortable time for metals. It'll be a great discount window for further investment, and it wouldn't shock me to see China absolutely cashing in and buying on unheralded numbers of gold and silver during the discount window period. And I would continue to suggest everyone should keep doubling down on investment. It's a monetary metal in a monetary crisis. That is the tool you want. You don't want copper, you don't want uranium. They might do okay, they might do very well, but the monetary metals will outperform in a monetary crisis. That is the tool for the moment. So overall, there's that slight risk that you go back above the 80s here on the gold-silver ratio. That could see silver. You were asking, can gold go to 3.5? It could go down to 3.5 at that point, and silver might even, be back at the 50s at that point. And the 50, there was such a huge resistance, multi-decade, all the way back to 1982, could now be utilized as support. And then there would be another great entry if it did at those levels. And by the time we start coming back down again on the gold-silver ratio, I would imagine you want to be more in silver than gold, but both will serve you very well.
Okay, Francis, a short view on your view on silver shortages, backwardation, LBMA, COMEX, and the other one is the oil prices rising. during this war periods or global uncertainty. Do you think oil is the next big opportunity, and what are the main risks?
I think oil's already quite high and has already had a substantially negative effect on economies due to the supply chain addition of costs for having things delivered, purchased. I think shortages on fertilizer could cause farming related shortages on food. That's going to push prices up. Remember, they want that. They've engineered that. You might say, have they? Have they really? Why does he say that? Because they want inflation, because they need to debase the debt and the fiat. And that's part of impoverishing you. And that's what they want to do because your impoverishment is their enrichment. So people should see that there is an adversarial role to government and central banking and their interests versus your own. They're not your friends. Government is not your friends. They're to be listened to and then inverted and take action that best suits your own wealth building, your own wealth protection, and your families, rather than the instructions they do. And in many instances, it's the polar opposite. So going back to your question, we want to you should continue to purchase precious metals, and it will have its day and come back in a very strong way. I don't see the direction the world is taking in terms of the bond collapse being able to work itself out. It's mathematics. It's compound interest. It's well past the point of reverse. The avalanche is already halfway down the mountain. It hits the village. Everybody needs to realize that. There's no Superman that'll stop the avalanche halfway down. There's rock, there's ice. You're getting hit by the debt-based collapse and the fiat and debt-based collapse, regardless what nation you're in, really. So there's going to be probably a global depression as a result of this, because even if we westernize the worst impacts, there's going to be knock-on effects for countries such as India, who are supplying goods to that. There'll be knock-on effects for China that are selling knickknacks to Americans to buy. They're going to not have the money. They're going to have debt-based issues. They're going to have re-ratings in their property values. They're going to be re-rating their entire living costs, and their true wealth is going to be downward re-rated immensely. So the disposable income globally from the West is going to drop phenomenally. And they've earned it by the nefarious activities, that is a coordinated destruction of intent, by not having sound money principles. They know that, and it's done because they seek ultimate control over the world through totalitarianism. And we're going to have a kind of technological driven communism, where everyone is freedoms of movement and privacy has largely been removed, and government sees itself as slave master that can track, trace, decide how much you've spent and or allowed to spend, how much freedom of movement you have, etc., etc. So it's from that perspective, it's quite gloomy. That said, if you take the course of action that we're suggesting, the one thing that will help you is building wealth, because you buy back some of your rights as privileges if you have the means. Those that don't will have to eat government food and be poisoned by it, and their pharmaceuticals and everything else. Those that have secured self-reliance and have invested with their local farmers and are getting clean produce, they will survive and be strong. So there is a polarization for society coming, and most people are sleepers here. And my message, and the reason I spend so much time talking about this, like John the Baptist, is to warn of the forthcoming event, Noah, or whatever analogy you want. Wake up to this, it's real. And those that take action will have a significantly better lifestyle than those that are sleeping on this journey.
Well, Francis, any advice you can give, piece of advice you can give to our viewers, what would it would be?
It's imperative to build wealth now. I'm not money hungry, but the point of the matter is I'm lifestyle hungry. I want to maintain my current lifestyle, my privileges, and my freedom of movement and various other things. And now I've been made to realize that that's going to be a ward of the rich. It's imperative to be rich, call it inverted commas, to ensure you have a good lifestyle now. because most people will become ward of state. So what do you need to do? You need to build wealth. Well, amazingly, this whole transition process is going to throw up some of the best opportunities for trading with HVF method. We've already made the most millionaires, dollar-based millionaires in the last 5-6 months, from about October till especially the end of January, but even since, inside our community, just by utilizing HVF method to trade upside on silver. We were also trading Swiss franc, Japanese yen, the weakness of the yen, the strength of the franc, and a number of other trades, escalating our accounts since then. And we then turn those profits in this in-between period into blue pot, unleveraged silver and gold, and continue to build that foundation of wealth that will accrue to us as it comes. So you've got to build wealth, you've got to protect that wealth. You should also work on having a multi-jurisdictional, by nation state footprint, especially in areas where they will secure your capital gains tax-free, 0%, and other aspects. Those that are static and stay in the Western nations or other nations that are pursuing draconian policies will be taxed out of their gains by an aggressive government. So now is not the time to be stuck in the mud and static or show any inertia. You really need to be mobile and look after your interests structurally more than before. We focus on that on the Market Sniper YouTube channel, particularly. It's one of our first places to port of call. Check out our links there. You can book a call if you wish to come on board. It requires you to have manifested already. It's a high-end product done to a high standard, the HVF method community. And you can start building your wealth for these times, and it can accelerate rapidly as the breakdowns in the financial system occur. There are actually paradoxically going to be incredible opportunities, and I feel bad for the nurses of this world, the farmers of this world, but this is a speculator society. Greater money is being made by me doing speculator things than those doing honorable things. But this is the world we were born into. This is the circus we're born into. And we have to use the nature of it to best preserve ourselves and our dearest beloveds and family members. And this is what I keep reminding people of. So our YouTube channel, I'm also on X, by the way, under The Market Sniper. And we also keep an eye on the crypto markets, both on YouTube and on X, The Crypto Sniper. So you can follow us through both those channels. YouTube, and there are links there to our website, the www.themarketsniper.com, where you can also choose to engage and book a chat with us. Thanks for having me on, Umar. Nice to meet you.
Thank you, Francis. Thank you. This was a great discussion. Thank you for explaining everything. Thank you, everyone. Thank you, Francis, once again. Thank you, everyone, for watching this video. If you like this interview, before ending, you can follow Francis on their YouTube channel, on his X, and everything he explained. So thank you so much, Francis, and thank you, everyone, for watching. If you enjoyed this conversation, please hit the like button, subscribe to this channel, and ring the bell icon. Thank you, everyone. Thank you. See you next. Bye bye.